So you've probably heard the name Ray Dalio. He's a billionaire investor, and he's sounding a pretty serious alarm about a world order breakdown. What on earth does that mean for your money? Well, that's what we're here to figure out. We're going to translate his big picture analysis into a practical, step-by-step financial action plan you can actually use.
I mean, just listen to that language. A classic breakdown. He's not talking about a little market dip or a garden variety recession. No, he's pointing to something way bigger, a fundamental shift in the very rules of money, power, and how the world works together. It's meant to grab your attention, and for good reason.
And this, right here, is the question that really matters. It's one thing to talk about these huge global trends, but what we all want to know is, okay, how does this actually hit my wallet, my savings, my investments? That's the gap we're going to bridge right now.
Look, when a guy like Dalio uses a phrase like once in a lifetime, you tend to listen up. He's signaling that the old playbooks, the investment ideas that have worked for the last few decades, might not be the right ones for what's coming. But here's the key. This isn't about panicking. Not at all. It's a wake-up call to start preparing for a very different financial world.
So, before we can talk about solutions, we have to really understand the problem. What exactly is this order breakdown he's talking about? Let's get into the diagnosis.
At its heart, you can think of the order as the foundation of our entire global system. It's the set of rules we all kind of agree on about money, trade, and power. Dalio's whole point is that this foundation is starting to crack. It's becoming unstable and way more unpredictable.
And this isn't just one thing going wrong. Dalio sees it as a perfect storm hitting three major systems all at once. First, you've got the monetary system, which is straining under massive government debt. Then there's the political system, which is just full of internal conflict and polarization. And on top of that, you have the geopolitical system, with huge competition between world powers. The scary part? They all feed off each other, making the whole situation even more volatile.
And this is maybe the most powerful metaphor he uses, an economic heart attack. It's so vivid because it highlights the speed. His point is that confidence is everything. And when it starts to go, things can spiral from looking okay to being in critical condition almost overnight. It's a serious warning not to get complacent.
Okay, so we've diagnosed the problem. Now for the good part, the prescription. Given this pretty challenging outlook, what's Dalio's actual playbook for protecting yourself? Let's dive into the solutions.
His whole approach really comes down to three basic pillars. Number one, diversify and do it broadly. We're not just talking different stocks, but different kinds of assets, different countries, and different currencies. Number two, cap your risk. This is huge. Don't put all your eggs in one basket. And number three, stay liquid. You need to have enough cash so that if things go south, you're not forced to sell your investments at the absolute worst time.
All right, a really key piece of this playbook is using what are called hedges. Now, the best way to think about a hedge is like fire insurance for your house. You don't buy it because you expect your house to burn down. You buy it so you're not financially wiped out if it does. Well, these financial hedges are basically insurance against that monetary strain we were just talking about. And it's super important to understand their different jobs. Your traditional assets, your stocks and bonds, they do great when the system is stable and chugging along. But hedges, like gold or even Bitcoin in Dalio's view, they have a different job. Their job is to protect you if that system comes under serious pressure, like from a debt crisis or a currency losing its value. They're for protection, not just growth. Now, this number is critical. Dalio gets really specific here. He advises capping your allocation to these kinds of hedges at around 15%. And the reason is simple. You're trying to avoid concentration risk, so you don't want to just create a new one by going all in on hedges. It's all about finding a smart balance. So here's what that could look like. Pretty straightforward, right? The vast majority of your money, that big 85% chunk, is still in your core portfolio doing its thing. But then you have that smaller 15% slice, which is your hedge, your insurance policy. See? It's a strategic adjustment, not a complete radical overhaul.
Okay, we've gone through the diagnosis and the high-level strategy. Let's bring this all home. What are the practical steps you can take right now to actually put these ideas to work for you?
It all begins with a simple three-step financial health check. First, you've got to audit your own balance sheet. Get a totally clear picture of what you own and what you owe. Second, you need to stress test your finances. Ask those tough what-if questions. And third, based on what you find, you build a real plan to rebalance and make yourself more resilient. And to help with that audit, start asking yourself these kinds of questions. And be honest, are you way too concentrated in one stock? Is your mortgage a ticking time bomb if rates go up? Do you have enough cash to ride out a storm? Answering these is the critical first step to building a truly robust financial life.
You know, at the end of the day, this isn't about having a crystal ball. Nobody can perfectly predict the future. The real goal is to build a financial plan that is so solid, so robust, that it can handle a wide range of surprises. Your success shouldn't depend on being a perfect fortune teller.
So, we've walked through Dalio's diagnosis, his playbook for building resilience, and a clear action plan to get you started. And that brings us to the final, and really the most important question of all. It's time to take a hard, honest look at your own finances and ask, is my portfolio really ready for what might be coming next?